You've built a $4 million portfolio, but still feel anxious about spending it, unsure what kind of life it can actually create for you. Maybe you're checking your accounts late at night, refreshing the numbers, just to reassure yourself it's still enough. But if you don't get clear on what you can spend, you'll keep oversaving, you'll miss your window to live generously, and you'll hand more over in taxes than you need to. So this video breaks down exactly how much you can afford to spend and why the number alone hasn't made you feel more secure. So you can finally stop second guessing, spend with purpose, and step into retirement feeling confident you'll be okay. Because what if the real risk in retirement isn't spending too much, but spending too little? Most people assume overspending is the danger, but what if the opposite is more common? See, for example, if this couple with a $4 million portfolio in investments in a classic 60-40 portfolio limited themselves to spending just 4% of their portfolio each year, adjusted for inflation, backtests show there are over 53% of instances where they would die with more money than when they started. Now, most people follow this 4% rule because they are afraid to overspend. Because even with strong portfolios, many people live with a scarcity mindset. There's a fear that a market downturn, a medical event, or unexpected costs could ruin everything. So they play it safe. They stick to conservative rules and defer spending, just in case of those 10% chances. And often this mindset comes from years of accumulation mode. You've been taught to save, and save some more just for good measure. And when the time comes to spend, it just doesn't feel natural. The default in retirement is to underlive your potential just to feel secure, but the data tells a different story. Take Dan age 65 and Kim age 64 as an example. Their goal was to retire now. They have an investment portfolio of $1.4 million in a joint brokerage account, with about half that being basis, $1.6 million in Dan's 401k, and $1.2 million in Kim's rollover IRA. In the projection we are assuming a moderate growth investment strategy of 2.6% returns net of inflation in the first 10 years and around 7.3% returns net of inflation over the remainder of retirement. Now, of course, there's no guarantee in this, just an assumption backed by historical data. Now, I'll get into more of their plan specifics in just a moment, but based upon what they thought they could spend, in every single one of the thousands of simulations we ran, their lifetime experience would be above planned. And in 0 cases, it would be below. See, they weren't just okay, they were dramatically underspending and unknowingly sacrificing joy and freedom. This isn't just about, missed vacations or nicer restaurants. It's about quality of life, about taking the grandkids to Disney while you still have the energy, about saying yes to opportunities without guilt. So the real risk isn't overspending, it's missing the window to live fully while you can. And that window doesn't stay open forever. Now, Dan and Kim had a number in mind that felt comfortable. But what made it feel safe in the first place? And was it actually a number grounded in risk? Well, they assumed they could spend $9,000 a month on core living expenses to maintain their current lifestyle. In addition, they wanted to spend $30,000 a year for travel for the next 15 years while they still have their health and they can take overseas trips. And they wanted to keep giving at about $20,000 a year. Now, Kim will have 1 year of pre-Medicare insurance premiums at $800 a month. So that's an extra expense we needed to account for. So if we add that all up, that's around $167,000 per year, which is about 4.2% of the portfolio total, which sounded reasonable. Now, of course, this is before we consider taxes, but to them, they thought it would work. This all seemed to fall in line with the traditional rules of thumb. But here's the thing, they weren't actually tracking what was truly coming from their portfolio. They were focused on the total spending number. And that's because they weren't sure how to account for things like Social Security benefits, when benefits may not start right now, and you need to lean on the portfolio to create all the income until benefits kick in later. But when we dug deeper, we found they were on track to only withdraw around 2% of their portfolio. They were limiting their potential simply because of a desire to stay conservative. And in reality, they were leaving a ton of lifestyle on the table without even realizing it. So while the $9,000 a month target plus all their other expenses felt safe, it wasn't based on risk or reality. It was based on an assumption. And assumptions left unchecked can lead to decades of underliving. Now, if you're thinking, well, Alex, isn't that better than the alternative? Let me ask you this. Would you rather adjust your spending down by, say, $500 a month when things don't go as planned, or live 30 years with regret about what you didn't do? And that's because most people think of retirement income as a single stream, but understanding the sources and timing is the key to feeling confident in your plan. Dan and Kim assumed they'd be drawing evenly from their accounts, but they didn't map out where the dollars were really coming from. In reality, year one of retirement looked like this. Kim would start Social Security early, and the rest comes from their brokerage account. Then in year two and beyond, the withdrawals from the portfolio dropped dramatically to that 2% figure I mentioned earlier. And because of how long-term capital gains and standard deductions work, they would pay almost no federal tax in that first year. So their retirement paycheck wasn't just $14,200 a month, it was $14,200 a month with virtually zero tax drag. So to summarize this all, they could meet all their expenses after taxes have been considered. In the first month of retirement, they would have Kim's Social Security benefit and would take about $11,600 from their brokerage account. Their needs are met, and this is a good plan. But what happens when you optimize both income sources and tax strategy? In other words, how much could they actually spend? And see, the numbers might surprise you. Again, you might recall the initial projection showed they could spend about $14,200 a month, which would meet all their lifestyle, expense, and tax needs. And it was a good plan, but was it a great plan? So instead of asking, can we spend this? Instead, we asked, what can we spend? And a whole new world is unlocked. As you can see, in reality, they could spend closer to $22,000 a month. That's $7,800 a month more than they were thinking. Now, if you're wondering how that's all possible, let's look at the numbers. As you can see here, after rerunning the numbers with a more dynamic approach, it turned out Dan and Kim could spend $248,000 in their first year from their brokerage account. And as Dan's Social Security kicked in later, their needs to draw from the portfolio drops. And if we follow what the academic research shows, which is most people spend more earlier in retirement, less towards the middle, and increase towards the end of life, they unlock a whole new world of opportunity. Because not only could they spend more now, they could do it with confidence that future years wouldn't require a massive course correction. The projection wasn't just a snapshot assuming the same spending and rates of return throughout retirement. It accounted for the natural ebbs and flows of retirement. And that's because retirement is not static. Spending shifts, income shifts, life happens. So if your plan only works in year one, it doesn't really work. You need a plan that adapts and considers all income sources, the timing and the adjustments you'll likely make along the way. Now, even with the higher spending, their plan still showed a 99% success rate of income being above planned over their lifetime. So instead of hoping they were spending the right amount, they could finally see it. And more importantly, they could trust it. They stopped asking, can we afford it? And started asking, is this the life we want to live? But let's stress test the plan, because even with these numbers in mind, you still might be asking, but what if the market crashes? Would they need to slash this higher spending? But because Dan and Kim had dynamic income guardrails in place, their plan would flex with an unknown retirement. The plan didn't assume perfect straight line returns. It planned for volatility, and it showed them exactly how much their income would need to change, if at all. So even if their portfolio were to drop by 45%, their income would need to be cut but only by about $800 a month. Now, at this level, that's a minor tweak at around 3.6% from what they could spend. It's not a lifestyle disruption. But we can take this one step further and model their plan with this higher spending amount against some of the worst periods in history, such as the '08 financial crisis, which we can see their plan holds up very well. Now, it wouldn't have been stress-free, but this allows them to spend boldly, knowing exactly when and how to pull back if needed. And if the downturn never came, well, then it's even better. This is the power of proactive planning. It turns the question from what if the market drops to how will we respond? Because downturns are inevitable, but with the right strategy, they don't have to be disastrous. Knowing you have a system in place takes the emotion out of decision making. It keeps you from overreacting and gives you permission to stay the course. Now, what many people don't realize is that playing it safe has a price too. Now, again, we could assume some linear projection on their returns over their lifetime, but that's not entirely realistic because when you earn those returns in retirement matters. But as we will see here, if they play it safe and spend less than they could, the median scenario is that they would end their life with around 2.9 million in today's dollars. And there are some instances where they would die with over 8.5 million. Of course, this excludes the value of their home, so they are leaving a lot of money on the table. But in the optimized income plan, the median scenario is about 1.1 million. But more importantly, look at how the best case scenario is a more reasonable 3.3 million. Most people we work with aren't interested in leaving a bigger balance behind just for the sake of it. They want to enjoy life with the people they love while they are still alive to spend time together, share their values, and pass on wisdom before wealth. Too many people operate under a scarcity mindset even when abundance is possible, and that mindset costs them more than they realize. So yes, play it smart, but don't confuse caution with wisdom. True wisdom is using your resources with intention and a well thought out plan supported by data. Now, most people focus on spending or saving, but what if the tax strategy is the key to unlocking both of these things? To take Dan and Kim's optimized income plan even further, if they stuck with the default order of withdrawals, taxable and then IRAs, they'd avoid taxes now, but create a massive tax bill later. Their IRAs would balloon and their RMDs would spike and they'd lose control over how much they owed. Instead, by strategically converting pre-tax dollars to Roth, slightly beyond the 12% bracket but below the first IRMA bracket, they smoothed their tax curve out and limited future spikes. That one decision reduced their lifetime taxes by $460,000 adjusted for inflation and increased their total net income by the same amount. And it didn't require anything radical, just proactive planning aligned with their goals. This is the value of holistic financial advice. Not just answering, can we retire, but showing you how to retire better, more flexibly, more generously. Because the goal isn't just to lower your tax bill, it's to create space in your plan, space for freedom, for giving, and for margin. So yes, the numbers matter, but they're not the end goal. The real win is aligning your money with your purpose. So what does that look like for you? See, for Dan and Kim, they wanted to spend more time with family, more travel, and more giving. They could afford to spend more, but the question wasn't just how much, it was why. For them, it meant bigger family trips, more support for missionaries, and the freedom to say yes without guilt. And maybe for you, it means something else. Maybe it's retiring sooner or helping your kids. The beauty of good retirement planning isn't just math. It's clarity about what matters most and the confidence to live it out before your window closes. Because in the end, the most valuable asset isn't your portfolio. It's your life you want to live in the time you have left. So let's make sure you're spending both wisely. Now that you've seen how even a 4 million portfolio can leave you feeling uncertain about what you can spend, what actually changes if you had 5 million instead? and what doesn't change even when the numbers double. Watch this next video where we compare 2.5 million versus 5 million retirement plans side by side and uncover why more money brings more choices, but also more complexity. I'll see you over in that video right now.